Yo, what's going on, everybody? Welcome back to the next section in the course. So in today's lesson, all we're simply going to be covering are the different types of market conditions. Now, as a price action trader and learning to become a price action trader, we need to be able to identify these price action conditions. So in terms of when we're actually looking to make a decision within the market, whether we want to buy or whether we want to sell, we need to be able to identify these market conditions. So we're going to start learning about actual price and price fluctuations so we can make the best, most logical decision in the future when it comes down to our trade ideas. Now, in this lesson, all we're simply going to cover is market structure, trending markets, consolidating markets, changes in trend, and the new trend confirmation. So now let's cover the different types of market conditions, the different types of trends that we're going to see within the markets. So again, later on, we can implement everything that we learn in this section and look for the best opportunities within the market. So there are your three main market conditions. You have your bullish trend, which is an uptrend. We have a bearish trend, which is a downtrend. And we also have a consolidation or a sideways trend. There's many terms to, identify that or say it's, consolidation, consolidating, ranging, sideways, whatever you want to call it. So let's get into the bullish trend first. Now, when we're actually going to be identifying a bullish trend, here is a quick summary of a bullish trend. So the simplest way for me to put it is if you zoom out on the chart and you see price moving from the bottom left hand side of your screen, meaning down here, to the top right hand side of the screen, meaning all the way up here, then most likely we are in a bullish trend. Now, when we break it down and put things in a little bit more detail, in a bullish trend, price is actually making higher highs and higher lows. All that simply means is that there are going to be more buying opportunities in the market than there are going to be selling opportunities within the market. Now, typically when price is in a bullish trend, you're only going to be wanting to look to buy. Again, price moves off of supply and demand. Price moves based off of where the market makers want to take price. So if the market makers want to take price up, there should be no reason for you to look to actually be going to look for sells, right? And again, right, there's going to always be more bullish opportunities than bearish opportunities, meaning that there's going to be more available trades for you to actually buy that specific currency pair. Now, let's break down what a bullish trade actually is. So here we're just going to pretty much have some, drawings within this example. Along with the rest of the slides in this section, we're just going to kind of go over drawings, and then in the next video, we'll go into the actual price action chart and start breaking everything down. So this is an example of what a bullish trade would typically look like, or what a bullish market condition would look like. So as you can see, there are higher highs and there are higher lows. Now, why are they called higher highs? If we look at high number 2, we can see that the second high is higher than the first high, meaning it is a higher high. It's literally as simple as that. Now, if we look at the second low, or low number 2, it is higher than the first low, meaning it is a higher low. It's literally as simple as that. Again, when price is in a bullish condition, we're making higher highs and we're making lower highs. So again, the second high right here, this green one, is higher than the first one. Now that's going to be considered a higher high. And then this low number 2 is going to be higher than the first low. That is going to be a higher low point, right? So if we look at this first move to the upside here, and then we have a pullback. This is what you call a pullback within the market. When price is actually going down, this is going to be considered a pullback for price to make that higher low. After the pullback is done, notice how price comes up and makes a higher high. And again, this is going to be considered a higher high because this high is higher than the first high. This is going to be considered a higher low because this low is higher than the first low. And how typically you'd want to trade a bullish trend is you're trying to identify where you could potentially look to get in on the next higher low point, right? Again, we want to buy at a discount, right? So if we look at low number 3, this is where we would want to buy. We don't want to buy at a higher high. We want to buy at a higher low. Now, it's literally as simple as that. There's really no need to overcomplicate it. But, just some notes that you could take from, that simple section would be that market structure will only be higher highs and higher lows in a bullish condition. Now, when you trade with the trend, you're always going to find higher probability trades. So you always want to be trading with the trend. Another term that you could say within trading is that the trend is your friend. Don't try and trade against the trend ever, because you're going to start taking more unnecessary losses. Now, let's identify a bearish trend. So the concept is very similar. It's almost the same. It's literally just the opposite. So in simplest terms possible, in a bearish trend, price is moving from the top left hand side of your screen, where my camera is, to the bottom right hand side of the screen, where the day trading institution logo is. Now, in more trading terminology, right, in more trading terms, price is simply making lower highs and lower lows. And all this simply means is that there's going to be more opportunities to go short than there is to buy, which you should only look to sell the market when price is in a bearish trend, meaning it is making lower lows and lower highs. Now, this is going to be a little bit of a different chart, but in this situation, notice how we have a low, then a lower high, then a lower low, then a lower high, then a lower low, then a lower high, then a lower low. Notice how price is moving from the top left to the bottom right. And notice how each high is getting lower and each low is getting lower. It's as simple as that. LH stands for lower high and LL equals lower low. Now, notice how each low is significantly getting lower and lower. Remember, look at each L getting lower and lower, and look at each LH getting lower and lower, right? LH stands for lower high and LL stands for lower low. Again, this is going to be considered, if we kind of look at my mouse cursor here, this is going to be considered a lower low because this low is significantly lower than the second low, making it a lower low. And this LH right here, the last one, is going to be considered a lower high because this was the highest price point that price pulled back to before continuing to make the next lower low, along with this lower high point, or this high is significantly lower than our previous lower high, making it a lower high. And it's literally as simple as that. Again, there is no need to overcomplicate it. Maybe you may be overwhelmed at the fact that you're just kind of learning about all this information now. Again, it is a simple concept that you'll get very quickly. So just some notes that you could kind of take away from that is that in a bearish condition, market structure will only be making lower highs and lower lows, nothing else, right? And again, you always want to trade with the trend. So if price is telling you sell because you read lower lows and lower highs, only wait for the sell opportunity to look to actually sell at each one of these lower high points. Obviously, we're going to get more in depth with it as the course progresses, but we're still in like the beginning section, so we need to make sure you understand these core principles in terms of market structure. Now, let's identify a consolidating market. So when price is consolidating, price is simply moving from the left side of the screen to the right side of the screen, or price is making highs and price is making lows. It's not making lower highs, it's not making lower lows, it's not making higher lows, it's not making higher highs. It is simply making highs and lows. Now, typically when price is consolidating, these aren't the best trading conditions, meaning that you're most likely just going to get stuck within a fluctuation where price isn't hitting your stop loss, nor it's hitting your take profit. You might be in profit, then you might be in drawdown. So these trading conditions aren't the best, but if the consolidation range is big enough, then you could definitely make money off of it. Now let's break down what a consolidation phase in the market actually is. So notice each green little bubble here, or this green circle here, is going to be prices highs. Now the red little circles here are going to be prices lows. When price is actually consolidating, all it simply is doing is making highs and making lows. Notice how they're equal in where they turned around and moved in the opposite direction. Every time price hit this line down here, where the red circles are, it went in the opposite direction. Those are going to be lows. When something is considered a low or a high, it is equal in price to the previous low or high. Now that doesn't mean the exact specific price, but it's within the same zone and it went in the opposite direction. So if we just take a look at it here, we can see that they're all equal. This is how you're going to be able to identify a consolidating range. Price is simply making highs and price is simply making lows. Now again, key takeaway notes for ranging markets. price is moving sideways, only making highs and lows. It's not making higher highs, it's not making higher lows. Ranging markets simply mean that price is not trending. Typically, when price is actually ranging like that, decisions are being made where price is going to go next. All it's simply doing is price is accumulating a certain amount of liquidity to make the next move, right? Now, you can still profit, again, depending on the size of the range. Now, let's take a look at the break of structure and learn what an actual break of market structure is. Typically, a market structure break, or a BOS, is, in short terms, how you could call it, a BOS, is when the trend has broken, where you could see a potential if you believe that there will be a reversal or change in trend, right? So again, when price actually does break structure, most likely it will change in trend. So now let's look at some examples. So this is going to be a breakdown of a bullish break of structure, right? A bullish break of structure is when the bearish trend breaks and price starts going bullish. So again, going back to the simple concept of lower lows and lower highs, everything in red is going to be the bearish trend and everything in blue is going to be the bullish trend. So we have a lower high, lower low, lower high, lower low, lower high, lower low. We know that is a bearish trending condition because, again, going back to earlier in the video, we know that when price is making lower highs and lower lows, price is simply in a bearish trend. Now, what changed here is price went from a lower low to a higher high. All that simply means is that price went from a lower low to a higher high, and price broke the previous lower high, right? So when price broke the previous lower high here and actually made a higher high, that is going to be considered a break of structure. Now notice after this higher high was made, there was a higher low, then a higher high, then a higher low. That's how you can identify that there could be a potential change in trend when the first lower high is broken. And again, this is going to be considered a higher high because it broke above the previous lower high, which in this situation, this is a lower high in the result of a higher high. It's as simple as that. There can't be a break of structure if price breaks a previous higher high, makes a new higher high, because that just simply means that price is in a bullish trend. But in this situation here, how price broke the previous lower high and made a higher high, that is going to be considered a break of the previous lower high and is going to be considered a break of structure. Now, when price breaks the bearish structure by forming a higher high, that is going to be the result of a break of structure. Now let's take a look at an example of a bearish break of structure. Now, a bearish break of structure is when the bearish trend breaks, and all it simply means is price broke the bearish structure by forming a lower high in the result of a break of structure, or my bad, bullish structure. Price breaks the bullish structure by forming a lower high in the result of a break of structure, right? In this situation here, if we look at price, we see price has made a high, a higher low, higher high, higher low, higher high, higher low, higher high. Again, this is going to be considered a higher high because it is higher than the previous price. Now, when price breaks the previous higher low and forms a lower low, meaning that this low is lower than the previous low here, right? It is going to be considered a break of structure because we broke structure to the upside. For price to maintain higher lows and higher highs, meaning a bullish trend, it can only make higher highs, higher lows, highs, and lows. Once you have your first lower low in a bullish trend, the trade is, or the trend is no longer valid, right? So that's one thing that you should take put in your notes. The type of structure that you're going to see in a bullish trend that can maintain it to be valid are higher highs, higher lows, highs, and lows. Once price makes a lower low, the trade or the trend is no longer valid. Same thing for when price is in a bearish structure. The only structure that will maintain a bearish structure is going to be a lower high, lower low, low, or high. If price makes a higher high in a bearish structure, in a bearish market condition, then the trend or the trade is no longer valid. So in this situation here, how price made a higher high, a higher low, a higher high, then a lower low, this break right here of the higher low is going to be the break of structure. Now notice after that, price made a lower high, lower low, then a lower high. That is going to be considered the break of structure. Now, let's take a breakdown of what a ranging market looks like when it breaks out to the downside, meaning that it is a bearish break of structure, right? So a range break of structure is when price breaks the range to the downside. That is going to be a break of structure. So again, in a ranging market or a consolidating market, remember price is only making highs and lows. So here we have a high, a low, a high, a low, a high, and then notice how we have a lower low. That is going to be the break of structure here. Now, in a situation where you're trading this live, all you simply want to do is wait for a retest of the previous lows and look to actually sell. And that's how we can make money. And again, when it comes down to this range here, once price made a lower low, again, this low is going to be considered a lower low because it is lower than the previous low, which is going to be this one over here. That is going to be considered the break of structure, and that is going to be the break of structure for this ranging condition, right? So price broke the low of the range in result of a lower low, and that is your break of structure, and that is when you can expect price to continue the going down. Now, the same thing for the bullish side of things, right? In a range, we know that price makes highs and lows. Here we have a high, low, high, low, high, low. And then here we have a higher high. Again, this is going to be considered a higher high because it is higher than the previous high. Once price made a higher high, that is going to be considered the break of structure. Then you can see after that price made a higher low and then a higher high. And all that simply means is that price broke above the high of the range and result of a higher high. Now remember, all of these are very, very simple concepts, and practice makes perfect. So the more you apply yourself and you take notes on each one of these sections and you go on the actual charts and start to look to identify these terms and concepts, then better you'll be able to identify them. And again, trading is all about experience. So you need to be able to show up to the markets every single day and look to implement what I'm teaching you here. Now, last but not least, let's go over a new trend confirmation, which is going to be super important because you need to be able to identify when the trend actually changes from a bearish trend to a bullish trend or a bullish trend to a bearish trend. Now, I believe I skipped one, but anyways, what is a three-leg extension? So a three-leg extension is a pattern we use to confirm the new trend after a break of structure. So we're only going to find a three-leg extension after a break of structure. When there is a break of structure, you want to look for that three-leg extension to confirm the new trend. Because sometimes in the markets, again, there's multiple time frames. And depending on the time frame that you're trading, let's just say you're trading the lower time frames, right? And I'm trying to keep this as simple as possible so I don't confuse you, and just try and make sure you understand everything. But there are going to be multiple trends, depending on the time frame, right? So sometimes you might see a break of structure, let's say on the 15-minute time frame, but on the hour time frame, they're still in a bearish trend. So you want to wait for these three-leg extensions, especially like on a lower time frame, to confirm the new trend. And again, a three-leg extension is simply a pattern for us to be able to identify a new trend. So now this is going to be in black, is going to be the original bearish trend. Notice how price made a lower low, lower high, lower low, lower high, low, and then price made a higher high. That is the first leg in our three-leg extension, right? This first red line that we have here is going to be the first leg in our three-leg extension. The pullback where price made this higher low is going to be the second leg in our three-leg extension. And then the extension to the upside where price made a higher high is going to be the third leg to our three-leg extension. So this pattern that we have right here is going to be our three-leg extension, and that is going to be a break of structure to the upside. So here is a bullish three-leg extension. What is in red is going to be the bullish three-leg extension, and what is in black is going to be the bearish trend that broke. Now, let's take a look at the three-leg extension for a bearish condition, right? So this is going to be the three-leg extension for the break of a bullish trend. So notice how price is making highs, higher low, higher high, higher low, higher high, higher low, high. That is going to be our bullish trend in black. And what is in red is going to be our three-leg extension. So our first leg is going to be this break of structure that we have here. Once price broke under this higher low point, we made a three-leg extension. Well, in theory, technically looking at this hindsight, it is. But if you were trading live, that is the first leg right here. This move to the downside where price made a higher low is going to be the first leg. The pullback is going to be the second leg where price made a lower high. And then once price made a lower low, that is a three-leg extension completion, confirming the new trend. Now, just because there's a three-leg extension doesn't always mean price will continue to go down. What can happen sometimes is price hits a major level of supply, a major level of demand, and form a new three-leg extension after that. But, we'll get into all of that later on. Trends come and go. You don't always want to be married to one specific trend, but you want to be able to ride out one trend as long as you possibly could. And that is simply it for this section. So in the next video, we're going to be going over, applying this in the actual price action chart and looking for real examples in the market. So just keep in mind, these were the key points in understanding market structure. Now, again, let's go back into the actual charts and find these examples so you guys can identify them later on.